Having digested the Fed's minutes yesterday, investors are now focused on the tense U.S. labor market. Employment data commonly trigger high volatility on Wall Street because investors are looking for the signs that the labor market is cooling down. The JOLTs job openings showed on Wednesday that the number of vacancies dipped in baby steps. Today, the market has to absorb weekly jobless claims and the ADP employment report. InstaForex analysts are ready to share their analysis and forecasts. The New York session yesterday was the first day of growth on Wall Street in 2023. The benchmark indexes closed in the green, though not at intraday highs. Nevertheless, the key stock indexes regained losses incurred in 2022. The Dow Jones climbed 133 points, or 0.4%. The Nasdaq rose 0.69%, and the S&P500 logged the strongest performance. It grew 0.75% to close at 3,852 points. Wall Street is trading cautiously in the New York pre-market. The major stock indexes are oscillating around closing levels. Bearing in mind a series of employment data, the S&P 500 is expected to trade in the intraday corridor between 3,760 and 3,880 points. Wall Street indexes gained ground yesterday but closed much lower than their intraday highs. The reason is the Fed's hawkish minutes and strong data on the U.S. vacancies. At the meeting on December 13 and 14, Fed policymakers agreed that the central bank should proceed with the monetary tightening to deal with the high inflation, but further rate hikes should be gradual to curb risks for economic growth. In light of the minutes, investors were mulling over the Fed's further actions. Some investment managers warned that the minutes would not spring surprises. However, the market had the hope that the Fed would soften its rhetoric. The minutes of the latest Fed's meeting showed that interest rates could remain at elevated levels longer than expected. The policymakers said they need more evidence of the progress that inflation is firmly on the path to deceleration. All in all, the minutes reminded investors that interest rates would remain at elevated levels for the whole of 2023. Amid robust employment, the Fed will give priority to its fight against high inflation. According to the JOLTs job openings, there were 10.47 available vacancies in the labor market in November. The reading exceeds the consensus for 10 million vacancies. As for the Nasdaq, JD.com shares won favor with investors, having jumped by 14.7% on the back of hopes for full reopening of China's economy. Microsoft shares slumped the most, having lost 4.4% after UBS analysts downgraded their rating from a buy to neutral. The U.S. stock market was in suspense before opening today. However, the hope for weak hiring in the United States was wrecked by fresh statistics. The first case for the doom and gloom was the ADP pollster. The ADP employment report showed that the U.S. private sector added 135,000 jobs in December, 85,000 more than the consensus and 108,000 higher than in the previous months. Market sentiment was also dampened by a weekly report by the U.S. Labor Department. Instead of 2,000 increase, initial unemployment claims declined by 19,000 last week. The ADP report prefaces the government data on employment in the United States public and private sectors. Meanwhile, there are no signs that the labor market is cooling down. In turn, the Fed has no reasons to moderate the pace of further rate hikes. Such prospects are bearish for stocks. While the stock market is clouded, the US dollar regained its footing. Its index, which had printed losses for the most part of the day, gained 0.5% after the data on the labor market and rebounded to 104.70. The intraday CAD for the index is seen between 104.20 and 105.30. The US dollar, which had been under pressure for a few previous weeks, eventually got its second wind. The US dollar perked yesterday following the Fed's minutes, and now market participants reckon there is a 60.5% chance of a rate hike by 25 basis points in February to 4.50 or 4.75%. Still, investors believe that interest rates will reach their peak at slightly below 5% by June. Yesterday, Federal Reserve Bank of Minneapolis President Neil Kashkari underscored the necessity of further rate hikes. He expects the funds rate to rise to 5.4%. Today, the market will get to know comments by Raphael Bostic. The Canadian dollar did not enjoy its growth for long. With a bullish reversal of the US dollar, the USD CAD pair rebounded from its lows and is now trading higher. Having grown 0.3%, the currency pair climbed to 1.3523, and the intraday CAD for the instrument is defined between 1.3480 and 1.3590. The loonie is giving in to the stronger American rival. Besides, the Canadian economy is showing signs of a slowdown. In November, Canada's trade balance looked a deficit worth 40 million Canadian dollars. It's the first time a deficit was recorded for the last 11 months. The consensus assumed a profit of 610 million Canadian dollars. The reason is contraction in exports and a decline in oil prices. The Canadian dollar finds support today from a rise in oil prices, and crude oil has jumped by more than 2%. According to Refinitiv, a 9% fall in both benchmark rates on a Tuesday and Wednesday was the sharpest two-day fall since early 1991. Today, oil prices went up following a statement by leading American pipeline operator Colonial Pipeline. The operator halted the pipeline for technical maintenance. In response, Brent crude rose 0.9% to trade at $78.55 a barrel. The crypto market is trading in line with the inverse correlation to the US dollar. Investors gave up hopes that Bitcoin would consolidate above $16,800. Following the data on the labor market, the flagship crypto went down. The news is linked to the FTX saga. US prosecutors intend to seize the $460 million worth of Robinhood shares belonging to Sam Bankman-Fried, and the intraday CAD for the Bitcoin is seen between $16,600 and $16,800. And we wish you profitable trades. See you online tomorrow.